The Federal Reserve just defied Wall Street's expectations, holding interest rates steady. Your financial plans for the rest of the year might need a rewrite. Good morning. It's Wednesday, June 18th, 2025. I'm Alex Chen, and this is the morning briefing. Also, today the White House draws a new hard line in the sand in its tech war with China and what it means for your next smartphone. And later, a nail-biter vote in the Senate today that could fundamentally change how much you pay for prescription drugs. But first, let's break down exactly what the Fed's surprise decision means for your money. Our first story. The Fed plays the waiting game. Yesterday afternoon, the Federal Reserve's Open Market Committee concluded its two-day meeting. The big news is that they decided to keep the benchmark interest rate exactly where it is in the 5.25 to 5.5% range. This was a surprise. Most economists and investors were betting on at least a small quarter-point cut. That would have been the first one in over 2 years. In his press conference, Fed Chair Jerome Powell said that while inflation has cooled significantly, progress has stalled in recent months. He pointed specifically to the services sector, which includes everything from car insurance to haircuts. He essentially said the Fed needs more confidence that inflation is truly headed back to its 2% target before it starts cutting rates. So why does this matter to you? In short, the era of expensive money is not over yet. First, for your mortgage and loans. If you have been waiting for mortgage rates to drop before buying a home or refinancing your current one, this decision means that wait just got longer. The rates on credit cards, car loans, and personal loans will also remain stubbornly high. Now, there is a silver lining for your savings. Those high-yield savings accounts that have been paying out over 4% will continue to be a great place to park your cash for a while longer. For your job and the broader economy, this is the Fed signaling it is still more worried about inflation than a potential recession. By keeping rates high, they are tapping the brakes on the economy. This could mean companies are more cautious about hiring or expanding in the second half of the year. And finally, for Wall Street, expect a bumpy ride on the stock market today. Investors hate uncertainty, and they were really banking on a rate cut to boost corporate profits. The Fed just told them the party is not starting yet. And to be clear, this decision comes after economic data from April and May showed a slight, unexpected uptick in core inflation, breaking a nearly year-long downward trend. Next up, the new digital Iron Curtain. The White House has just escalated its long-running tech rivalry with China. Late last night, the Commerce Department, through an executive order, officially banned American venture capital and private equity firms from making new investments in Chinese companies. These companies are working on 3 specific technologies. Those are quantum computing, advanced semiconductors, and specific types of artificial intelligence. The order also requires U.S. firms to disclose their existing investments in these sectors. This might sound like a niche financial rule, but its impact is huge. From a national security perspective, the administration is essentially saying it will no longer allow American money and expertise, the smart money from Silicon Valley, to help build the technology that China could one day use against the US or its allies, either economically or militarily. It is a clear attempt to slow down China's race to tech supremacy. For the tech world, this forces a choice. It accelerates a trend called decoupling, effectively splitting the global tech industry into 2 spheres of influence, one aligned with the US and one with China. For American tech companies and investors, a massive and lucrative market is now much harder to access. And for you, the consumer, this could mean that in the long term, the technology in your devices comes from a more fragmented supply chain. It could lead to higher costs down the road as companies are forced to build new, non-Chinese supply chains. This is the most aggressive outbound investment restriction the US has ever imposed, moving beyond simply blocking Chinese tech from entering the country to actively trying to stop US capital from leaving it. Finally, to Washington for the billion-dollar pill vote. All eyes in the Capitol today are on the Senate, which is scheduled for a crucial final vote on the Prescription Drug Affordability Act. This bipartisan bill would expand Medicare's power to negotiate the prices of top-selling drugs. It would also, for the first time, cap the annual out-of-pocket prescription drug costs for seniors at $2,500. This vote is a classic Washington showdown with real-world consequences for your wallet and your health. The argument for the bill is straightforward. Proponents, mainly Democrats, and a handful of Republicans say this is a common sense measure to control America's sky-high drug prices. They argue that if passed, it will save taxpayers billions and provide immediate financial relief to millions of seniors who are forced to choose between medicine and other essentials. On the other side, the powerful pharmaceutical lobby and most Republicans argue that this is not negotiation, it is government price fixing. They warn that slashing profits will crush innovation, leading to fewer life-saving drugs being developed. The political stakes are high. The vote is expected to be razor-thin, potentially coming down to 1 or 2 swing senators. This is a major legislative priority for the president. Its success or failure will be a huge talking point for both parties heading into the 2026 midterm election campaigns. This bill builds on the Inflation Reduction Act of 2022, which first gave Medicare limited negotiating power, and this vote represents the biggest push to expand that authority since. So let's recap the big takeaways for your day. High interest rates are sticking around for longer as the Fed continues its inflation fight. The US is building a higher wall around its technology to block China. And a landmark vote on Capitol Hill today will decide the future of prescription drug prices. So what are we watching for today? 2 things. The market's reaction to the Fed's announcement throughout the trading day and the live roll call from the Senate floor this afternoon. We will have the results of that vote and the immediate fallout for you right here tomorrow morning. That's what you need to know to start your day. For a deeper dive into which drugs might be affected by the Senate bill, check out our latest article at themorningbriefing.com. I'm Alex Chen. Thanks for listening, and we'll see you back here tomorrow.